Hey, good day, everyone. We're going to get started in about less than 2 minutes. So welcome. Make sure that you have some water and coffee. And one of the things that I recommend for everyone is to make sure that you shut off your cell phone so you can go ahead and have your undivided attention. This is a lot of good information that I'm going to be sharing with you today. Just to give you a little bit of feedback on these types of webinars. These are taxes and retirement webinars, so we specialize. We do have a specialty in taxes, tax planning, and retirement distribution planning. But this is a much longer workshop that we do. I actually do these workshops at Florida International University, which is known here as FIU, and I do this once a month, and it's normally a 2.5-hour seminar. So what I have done is I have condensed it into a 60-minute webinar for you. So I've taken a lot of information out of here, but I'm also sharing with you a tremendous amount of not only information, but education that is going to help each and every one of you maximize your retirement benefits, reduce your tax liabilities in retirement, figure out what the new tax laws are and how they're impacting you and your family, and how they're going to be impacting your retirement distribution at some point in time in the future. Most of the attendees to either the seminars or the webinars, or even my own personal clients, they're people that are either in retirement or they're anywhere between 5 to 10 years from retirement. So we're going to touch bases on what are the problems? What are the things that you ought to be looking at? What are some of the tax consequences? We'll spend a little bit of time on that. And then I'm going to give you, toward the end of the workshop, I'm going to give you actual solutions. Plus, I'm going to give you an opportunity to have a tremendous benefit available to you as long as you stay till the end of the workshop and this webinar. So let me look at the time. I can see more and more people signing in, and I appreciate those of you that I have actually joined us on time. Normally we get, more and more people come in the first 5 minutes, but that being said, it's time to get going. For those of you that don't know me, my name is Bert Salazar, and I am going to be the host for this webinar today. And this is going to be very important. This is going to be full of information. And one of the things that I want to share to all of you, that my goal and that of my firm is to kind of help you and your family change the way that you see things. Because when you change the way that you see things, the things that you see change. So hopefully I'm going to be able to accomplish this with you today. I know that I will. So get ready, get going. One of the things that I'm going to do is I'm going to be shutting down my video, so you don't have to worry about seeing my face for the next 60 minutes or so. But I'm going to be sharing my screen so you can have access to the presentation that I'm going to be making to you. So, and then I'll bring my video back up at the very end so I can summarize some of the points that we've talked about in this webinar, and then we'll be able to talk about that tremendous opportunity that all of you are going to have as long as you stay till the very end of the workshop. Okay, so with that being said, let me go right ahead and shut off my video. Let me share my screen with all of you. And I would imagine now you can see it. Yeah, I can see, you can see it now. And let me take you right to the presentation. All right, so as I said before, my name is Bert Salazar, and I am going to be the host, your host, for this webinar today. Today's workshop is called Retirement in the 21st Century, and there are a lot of issues and concerns that you need to pay attention to. Most of the people that I engage for the first time that come into my office for me to do some type of tax planning or retirement auditing, I'm going to be touching upon here with you today. Again, bear in mind that this is a condensed version of the actual workshop. So when I'm going to have the next workshop is going to be February 26th at FIU in Miami. So I'll give you all that information for those of you that may want to attend. And it's going to be obviously, we're going to do a much deeper dive into retirement and the issues and concerns along those lines. So first thing I want to share with you is I don't work for the Social Security Administration. I'm not employed by the IRS. I do tax planning. Obviously, we do tax preparation, but I don't work for them. I have my own firm. I'm an independent. So it's important that I always give you the disclaimer along those lines. The examples that I'm going to be covering with you today are hypothetical in nature. And this is for illustration purposes only. So, you know, your individual results may vary depending on your tax situation. But at the end of the day, it is important for you to reach out to your advisors, your tax preparer, your CPA. If you don't have any of those and you want to use our services, then obviously you're welcome to do so. Now, the big question is why you're here. Well, I would imagine that you're here because you want to learn more, that you want to gather more information. Always remember that although there's more information in the marketplace than ever before, many times Americans are worse off than they've ever been. And the reason for that is that information without education always, always, always leads to failure. So, you know, there was a famous quote of a person that said, if I'm given 8 hours to chop down a tree, I would spend 6 hours sharpening my axe. And basically what that means is what you're doing today. You're trying to sharpen your axe when it comes to your retirement axe. You want to get more and more information. You want to become well educated. And by the way, the person that said that was Benjamin Franklin, and he said that over 200 years ago. And he was one of our founding fathers of the United States of America. So it's always good to pay attention to some of these statements that mean so much for many of us as we move forward through retirement years. Now, by the end of this workshop, you're going to be learning a number of things. Number one, you know, the relevant changes to personal income tax under the new tax law that took effect January 1 of 2018. Number two, the impact of those tax cuts and tax law changes on your retirement income streams, and that's going to be very important. Number three, how to identify tax tools and strategies that are going to be available and that are available currently to middle income retirees, like most of you on this call today. Number four, you're going to learn about the major retirement risks that you need to pay attention to and also be able to assess potential options. Number five, you know, how to manage your personal economy from a strategic perspective, which is very, very, very important. And last but not least, you're going to learn how to make the right decisions at the right time and for the right reasons. And if I can walk away and give you with good and leave you with good quality information, and you walk away with one or two good ideas that you have not heard before, then I think we've done our job for this short webinar. Now, there are 7 critical retirement questions that I encourage each and every one of you to make certain that you can address either with your advisors, your current advisors, future advisors. And again, if you want to reach out to me and address, you know, any issues that you may have, you're welcome to do so. I'm going to give you some information on that in the next few minutes. But there are 7 critical retirement questions that are a must for each and every one of you, each and every one of us to be able to get an answer to. How old will you be when you run out of money in retirement? That's a very important one. How much income will your retirement assets, savings, and your retirement assets produce? If you don't know the answer to these 2 questions, when will you run out of money and how much income will your retirement assets produce, then obviously you need to get an answer to those questions. Number 3, how much income is needed for your desired retirement lifestyle? Extremely important. How much will the taxes on your 401ks, IRAs, and Social Security benefits actually hurt your retirement income? You know, this number will actually shock you when we go through some of those numbers that are going to make you really think about how to start doing tax planning prior to retirement. How much will your income go down if the stock market crashes. Now, we have had a bull market for the last 10 years. Normally, bull markets only last about 5.5 years, but we have been on a 10-year bull market, so we're actually closer to a crash today than ever before. So how much will your income go down if all of a sudden, your 401k becomes a 201k because you lost 50% of the money there? How much of your retirement income is guaranteed? Very, very important. It's one of the most critical retirement questions that you need to answer. If the answer is 0%, then you have some challenges and you're in trouble. If the answer is 100%, then you can just live your life and enjoy life and just make sure that you can wake up on the green side of the grass every single day. And if the answer is somewhere between 0 and 100, then obviously you need to address that a little bit further as well. And then last but not least, do you have your money in assets that grow to outpace inflation, but then again, are fully protected from stock market crashes? I would argue that a percentage of your assets need to be in investments where your principal are totally protected. Now, Will Rogers said many years ago that the problem in America isn't so much what people don't know. The problem in America is what people think they know that just ain't so. Have a tremendous amount of information out in the marketplace, but again, information without education, as I said earlier, always leads to failure. And a lot of the information that you're bound to find, a lot of it may be totally erroneous and may not be applicable to your financial situation. The challenge is whenever I do an audit with a client or whenever I do some of these workshops, webinars, and seminars and so forth, is what I call the definition of insanity, which is doing the same thing over and over and over again and expecting a different result. You have to be able to make a paradigm shift. If everything you've ever known about finances and retirement is totally wrong, when would you want to find out? You don't want to find out 5 years from now. You don't want to find out 10 years from now. You want to find out today. You want to find out right away. So let me give you just a little bit of food for thought. What does a tax plan or tax planning and a colonoscopy have in common? Now, you may think this is funny, but it's not. And the answer to that question is simple. Nobody wants it, but everybody needs it. So if you've never done any type of tax planning and you're close to retirement, I encourage each and every one of you to reach out and do some tax planning with a known financial advisor or tax planner or tax preparer. The challenge is you're not going to find that many of them out in the marketplace, so you need to do your due diligence. Obviously, we're a tax planning firm, so if you elect to give us a call, then you'll have the opportunity to not only have a tax plan, but to have a complete audit of all your retirement assets. Thought of the day, and this was also said by a very famous person many years ago. That person said that the problem with our tax system is not that Americans pay too little. The problem with our tax system is the government spends too much. And the person who said that, and by the way, that was as true then as it is today. The person that said that was the 40th president of the United States, Ronald Reagan. Just give that some thought. Now, this workshop and this webinar that I'm doing for you today, it's got two parts. The first part will be the financial education, which is the one that I'm sharing with you. And the second part is a confidential strategy session. So if you stay to the very end of the work and the webinar, then I'm going to give you some information and that's going to be very critical for all of you at no cost or obligation. So because of this webinar and your attendance to this webinar, you're going to have the opportunity to engage my firm, to engage me personally in doing a confidential strategy session for you and your family. Now, just to give you a little bit of background on myself, who am I? Well, I'm a certified financial education instructor. I've been in the financial services industry for almost 30 years now, and I've been a tax planner for a long time as well. Just to give you a little bit more about my firm. In my firm, we do three things, and we do them very well. We do tax planning, we do insurance, and we do retirement distribution planning. On the tax planning side of the house, normally about 60 to 70% of the clients that we get on an annual basis come to us through the tax planning side of the house. Yes, we do accounting, bookkeeping, payroll services, and so forth, like a normal firm would do. But we also do tax planning and tax preferred retirement blueprints, which are very, very critical and makes us different than the vast majority of firms out there in the market, in the marketplace. On the insurance side of the house, we do a lot of long-term insurance planning. We do business services. We work with a lot of small business owners. We do a lot of their buy-sell agreements. We do estate planning. And then most important, we do Social Security, Medicare planning as well. And then on the retirement side, we specialize in investment in products that are non-correlated to traditional investments. So we do life settlements, we do principal protection programs. We want to make certain that our clients can have all of their assets fully protected in case of a stock market crash. And we do pensions for small businesses, and the like. So we specialize in working with a certain group of people. We don't want to be all things to all people, but we want to be some things to some people. And this is a market that we're mostly and most effective in on an ongoing basis. Now, everyone envisions retirement. Imagine those of you on the call today that are already getting closer to retirement, just drinking a little bit of water, is envisioning retirement from a different perspective. What I would argue is that it's not so much where you're retiring from, it's most important where you're retiring to. So it's very important to understand where it is that you're going to go before you try to embark on a trip to try to get there. Now, retirement preparation is very important. Actually, flawless execution of that retirement preparation is even more important than that. Some of you may think about, just having an extended vacation versus a new career. Some of you just want to retire and walk away. Others may want to retire from a job or a career and they want to start a new one. So it really depends where you're at. Some of you may want to travel and or live abroad. And that's important, especially if you're married. These are conversations that are important to have with your spouse, because at the end of the day, if one spouse wants one thing and the other one wants something else, it's going to be very challenging for you to be able to figure out where you're going in retirement. One of the things that I can tell you, though, is never, 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 ever allow your past to be bigger than your future. So you always got to think ahead and start thinking about ideas that are going to keep you very active when it comes to your retirement years. And if you happen to be married and there's some kind of an age differential, I have a number of clients that fit that profile. Well, that in many different ways may actually hinder retirement and enjoyment and success along those lines. So these are conversations that need to be had on an ongoing basis prior to retirement. Now, we all make financial decisions, and you may want to make it with yourself. If you're married, with your spouse, obviously you need to get your significant dollar involved in any type of financial decision that you're going to make. But at the end of the day, the biggest challenge that we have in making financial decisions is the fact that we do it one at a time. We do it at different times with different people under a different set of circumstances. So it's very, very difficult to do any type of planning if you have to make decisions one at a time at different times with different people under different circumstances. And if you don't have a foundation, if you don't have a platform of the landscape of where you're at financially and where you want to be and what's going to drive you and get you there the quickest, then chances are a lot of these decisions that you're making are not going to be apropos for your retirement benefits in the future. Now, we all have to deal with something that I call the rule makers. every financial decision that you make, more than likely, is going to include some kind of a financial institution. And the three major groups, obviously the US government, financial institutions, and large corporations. Now, if you understand how it is that they work, then you're going to be able to maximize the benefit not only for yourself, but also for your family. So you need to know what the rules of engagement are so you can start working within those rules, but try to get the best of them in order to maximize your business opportunities and get rid of the worst of them so it won't have a negative impact on your retirement planning at some point in time. Now, there are four basic operating principles that the government, financial institutions, and large corporations are always looking at. They want your money. They want it systematically. They want to hang on to it for as long as possible. And then they want to give it back as little as possible. One simple example of that would be a traditional 401k. So if you're 30, 35 years of age or 20 years of age and you work for a company that offers you a 401k, you know, the corporations encourage you, and the government, they encourage you to put money into your 401k. Why? Because obviously there are certain tax advantages. Actually, there are some tax advantages, but most of them are tax postponements, and we'll talk a little bit about that later. But the traditional 401k, you cannot touch your money. Now, you could borrow, or if you have some exigent circumstances, you can take some of your money out. But traditionally speaking, if you're 30 years of age and you're putting money out in your 401k, you cannot touch it until the age of 59 and a half. Otherwise, you're going to have, you know, all kinds of taxes and penalties that come along. Now, that's a very, very long time. So these institutions that you're giving them your money are actually using your money for their benefit. So you have to understand how those rules of engagement work in order to make certain that you can maximize the benefit and not be able to jeopardize your liabilities. So when it comes to a 401k, you only have an 11-year window in which to have the ability, actually has been extended now to 13 years, but you only have a 13-year window in which you can do anything you want with your money. And that would be between the ages of 59 and a half, and now under the new law that just came into effect January 1 of 2020, the age of 72. After that, you need to start taking the money out of your 401k, whether you want to or not, and we'll touch upon that in the next few minutes. Now, this may have applied to our parents, maybe our grandparents, but definitely not to us. But I think it's important to understand what the old paradigm was in order for you to understand the new paradigms. So in the old days and the old way of thinking, people actually worked for the same company all of their lives. They retired at 65 and received a guaranteed pension from that company. So that was a really good thing. They relied upon Social Security just for supplemental income because they had a really nice pension from their employer. And they use certain investments, small investments, primarily for supplemental retirement needs or variable needs or play money, whatever you may want to call it. Traditionally, they lived anywhere between 7 and 10 years, and then they died. So retirement was not a very, very long period of time. But then again, the rules of engagement have changed. So what is a new paradigm of retirement? Well, people are not working for the same company all of their lives anymore. The average American actually works for 7 different companies during their career. The 401k has actually replaced the pension for most Americans. Now, there's still some companies out there that have a pension plan, or if you happen to work in the public sector, you work for the government, you'll have a pension. But for the vast majority of Americans, that has gone away. So it has been replaced by the 401k. Retirement is mostly self-funded. So in the old days, if you had a pension, the liability of making certain that you got paid, the liability rested upon the corporation that was paying you that pension benefit. Now, the only way you're going to get paid is if you figure out how to do it, because now it is mostly self-funded and you have all the liability on your side of the ledger and not on the corporations that you work for. Social Security covers a smaller percentage of retirement income. Many Americans never fully retire. And for the most part, the average American is going to live anywhere between 20 to 30 years in retirement, and then they're going to die. So you got to plan for at least 3 decades in retirement, which is totally different than the old paradigm that we just covered a few seconds ago. So in summary, when it comes to retirement, I think it's important to know what you're retiring to as it is to know where you're retiring from. I think we've discussed that. Your retirement life is going to look much different than that of your parents. And you're going to have to adopt specific paradigms in order to address the new retirement challenges that you and your family are going to be bumping into as you start to get into the journey for your retirement life. So when it comes to taxes, you know, there's certain realities that I'm going to be touching upon today, because if you do have to manage taxation with your retirement distribution planning, then chances are you're going to live a really good life. If you don't have any type of tax shelters, chances are you're going to have some issues, major issues and concerns that you may not be able to do anything with. I like to say it this way: sometimes you're the windshield when it comes to taxes, most of the time you're the bug. So the key is, how can you start shifting the way that you do business today for your retirement? And I would rather you become the windshield and not the bug. So hopefully we'll be able to accomplish a little bit of that today. Now, this is a debt clock of November of 2019 for the first time in history. As you see there on the top left-hand corner, we just hit 23 trillion in our national debt. Never in the history of the United States have we owed so much money to so many people. What's even more challenging, right below that number to the right, the US federal budget deficit is north of $1 trillion. It was for 2019, it will be for 2020. What is the deficit? Well, that's a difference between what the government brings in and what we spend. Remember what Ronald Reagan said: the problem with our tax system is not that the government taxes too little, it's that they actually spend too much. So we're actually spending $1 trillion more than what we get every year in governmental revenues. That is just crazy, and it's going to get worse and worse and worse. Finally, if you look at the debt clock, and by the way, you can just go online and take a look at it, and it's always moving, so I just took some screenshots of this for you. If you look at on the bottom right-hand side, the U.S. unfunded liabilities are just north of $126 trillion today. Now, you may ask, well, Bert, what's an unfunded liability? Well, simply speaking, those are the promises that the U.S. government has made to all of us that they don't have the money to keep today. So you can just imagine what's going to happen in the very near future when it comes to taxes for each and every one of us on this call today. Now, you may not know this, but the 16th Amendment to the Constitution of the United States created the IRS and created the taxes for all Americans in the United States. The way you have to consider this is we are at historic high debt, but also historic low taxes when you go back to 1913, which was the very beginning of the IRS code. Now you're going to see there the tax map. The red is the highest marginal tax rate. If you look to the very left, you see 1913, that was the very beginning of the tax code. By the way, at that point in time, the government said that Americans were never going to be able, never, ever were going to pay more than 7.5% in taxes on an annual basis. Well, obviously you can see what has happened since. Now, other than that very beginning, and then the period there you see just to the right of that, were those years during the Great Depression that taxes were reduced in order to make certain that people could actually make it. Just look to the far right, and we're actually in the third lowest historical marginal tax rate in the history of our country. There was a point in time there in the 40s where the highest marginal tax rate was 94%, 94 cents out of every dollar. Now, so if we have more debt today than ever before, and we're living at the third lowest historical tax marginal rate in the history of our country, where do you think that taxes are going to go? And what have you done in order to prepare for that Armageddon, that tax Armageddon that is going to be upon us in just a few years from now? Now, what's the old paradigm of taxation? Same thing that we covered before when we talked about retirement and living a retirement life. Well, let's talk a little bit about taxation. The old paradigm was that you're going to be in a lower tax bracket when you retire. You're going to be living on less money and less income in retirement. Tax deferred investments, obviously, because you're going to be in a lower tax bracket, is the most effective way to build wealth. Well, but a lot of things change. The new paradigm of taxation is totally different than that one that I just covered for you. Your tax bracket in the future may be higher than it is today, and we'll touch upon that. You may need as much income in your retirement years as you did during your working years. Tax deferred contributions should only be made up to certain levels, and I call it optimum levels, and nothing more than that, because you need to create tax balances in your tax buckets, which we'll talk about in the next few minutes. And obviously, one of the main reasons why your tax bracket in the future may be higher than it is today is that you're going to lose most of your greatest deductions during retirement that you enjoyed while you were working. So you wonder, well, where did my deductions go? Well, here's what happens. When you retire, either if your mortgage is paid for, then obviously you have no interest deduction, so you can claim on your tax return. Or if your mortgage is almost paid for, then the vast majority of mortgage payments toward the end of the mortgage, a 30-year mortgage, for example, most of that money is now going toward principal. So the interest is the only thing that you can deduct. And obviously the interest would be minimal at that point in time. So you start to lose that deduction. Your children, obviously they're a big deduction while you are working. Not only are they a deduction, but they're also a credit. Now, they may still be living with you at home, hope not, but even if they are, you can't take a deduction for them. Qualified plans. If you were employed, you're probably putting money away in your 401k, your 403bs, your IRAs, any other type of pension plan that your employer had. But when you're in retirement, you're no longer earning income, so therefore you're no longer making contributions. So that deduction that you were able to take before, you can no longer take. Charity. Many of my clients make contributions to charity every single year. Interesting, when you retire, some of you may continue to put money into charities, but what happens is you start putting less money into charity, but you now start to dedicate and give more of your time. The challenge with that is that the IRS doesn't give you a tax deduction for your time, only the contributions that you make to a charity. So all of a sudden, now your tax brackets start, even with the same income, may actually start getting higher and higher as you move through your retirement life. Are taxes going up or down in the future? Well, I think we've talked a little bit about that, but let me just kind of share a little bit more information. Social Security, one of the major issues and concerns that we have with our taxes in the US is, how to fund Social Security, how to keep it alive. Medicare, Medicaid, big issues. Actually, Medicare is even a bigger problem than Social Security. Interest on the national debt. Remember, we owe over $23 trillion, and interest rates are low today. But when interest rates in the near future get back to normal levels, how much more money is going to take to be able to maintain and pay the interest on that debt? The DoD, the Department of Defense, prescription drug program, Fannie Mae, Freddie Mac, pension obligations. If you work for the government, there's a pension obligation. Guess who pays for government employees' pension obligations? All of us do. So obviously, all of these things are putting so much pressure on the US government that the only way they can relieve some of that tension is by increasing taxes in the near future. Now, what are our country's biggest expenses? Well, actually, there are just a few of them. Social Security, Medicare, Medicaid, and the interest on the national debt. And by 2020, by the way, which is this year, these four major expenses are going to account for 92 cents out of every dollar that the US government is collecting either in interest or in taxes from the American population. 92 cents out of every dollar. Guess what the other 8 cents need to be able to do under the current tax law? Well, they're going to have to be able to pay for all of this. Border security, children's nutrition, DEA, public housing, IRS, federal courts, Army, the Coast Guard, the Navy, you name it, Department of Family and Services. So all these billions and billions of dollars that are required to maintain these institutions have to be paid with only 8 cents out of every dollar. And that's not the only ones. Here are some of the others that we're going to have to pay. So you can now start to see the picture that the only way that we're going to be able to do something in the future is by curtailing some of the benefits that are being paid out, curtailing some of those promises that we have been making, but most important, increasing taxes significantly in order to make certain that we can cover these debts and keep the promises that we have made as a country to each and every single American. Now, there are three major financial tax buckets, and I'm not going to spend a lot of time in the seminar that I do. Obviously, I go into details, but these are the major financial tax buckets. You have your taxable bucket, tax deferred bucket, and your tax-free bucket. In your taxable bucket, you have your savings, your CDs, your traditional mutual funds. It is taxable because you get a 1099 every year, which obviously you got to pay taxes on that money every single year. The tax-deferred bucket, most of us know, obviously, those are your IRAs, your 401ks, your 403bs, your pensions, etc. That means that you put the money in pre-tax. The money grows tax-deferred, but then when you pull it out, you have to pay taxes on every dollar. So you have some deferral now, but then you'll pay it all later. And then you have the tax-free bucket, which is the Roth IRA, the Roth 401k, the 7702 plans, which are cash value life insurance plans, which are tremendous. And then obviously, last but not least, municipal bonds. The challenge is that whenever I do an audit for a client, what I notice is that the vast majority of the assets that they have set aside for retirement are either in the taxable bucket and the tax deferred bucket. So if taxes were to go up in the future, which they will, they have no shield whatsoever of protection. They have no tax shelter. So their taxes are automatically going to go up by 20, 30, 40, 50%, maybe even 100%, depending on where the government is going to go. So that's a major challenge for each and every one of us to consider, but I'm not going to spend much more time on this today. Now, we're going to talk a little bit about taxation. By the way, those are not my parents, but that's exactly how they looked when they got to retirement. Thank God that they had a son that was a tax planner and a retirement strategist that was able to help them along those lines for many, many years. But when you look at the traditional tax law that we live today, you know, there are actually, seven brackets. You have the 10, 12, 22, 24, 32, 35, and 37. Notice that our tax system in the United States is a progressive tax system. The more money you make, the higher the bracket gets. So that's important to note there. This slide here is going to tell you pretty much, this is if you do taxes yourself, if you do your own taxes, chances are you've seen this. Although the tax rates are progressive, that the more money you make, the more taxes you're going to pay. For each bracket that you move through, you're only going to pay taxes on that percentage that actually fit into that bracket. So for instance, for the first $19,400 that you make in income in 2019 and now in 2020, you would be in the 10% tax bracket. So when you get to the next bracket, that means that you would pay $1,940 in taxes, which is 10% of the 19,400, plus you will pay 12% over anything above 19,400. So between 19,401 and 78,950, in that bracket, any dollars that fall in there, you will pay at 12%, where for the first 19,400, you paid at 10%, and so on and so on. I go into a little bit more details on my seminar, but again, all I want to share with you is you want to try to maintain your marginal tax bracket and your effective tax bracket as low as you possibly can in retirement. But you have a lot of forces working against you. You know, your deductions are going away. The government is spending more and more money every day. So you have to start to create some tax shelter in order to avoid tax Armageddon. Now, this is on capital gains. Obviously, capital gains enjoy a much better benefit. And the reason for that is that the government says that if you put your money to work in the US economy by opening businesses, by investing in stocks, buying real estate, whatever it may be, because you're investing into the US economy, they're going to charge a lower tax rate. So take a look at it. For the first 78,000, remember in the previous one, for the first $78,950, you would have been in the 12% tax bracket and the 10 up to the 19,400. Here, for the first $78,750 that you have in capital gains on any given year, your tax liability is zero, where on the other side, the highest marginal was already 12% at that level. Now, between 78,751 and 48,488 and change, you would be in the 15% tax bracket. And then anything over that, you would be in the 20%. So if you're going to have to pay taxes in the future, I would rather you pay it under this scenario than as an ordinary income tax, because obviously ordinary income taxes are higher than capital gains taxes. Now, we're not going to get into details on deductions, exemptions, and credits, but what I can tell you is that the deductions and exemptions will reduce your taxable income. Credits actually reduce your tax liability. And if you do proper tax planning, you're going to be able to maximize all three of these for your benefit and for your retirement income needs in the future. So in summary, it's important to know how your personal tax brackets are going to be working for you in retirement. And you still have a small window of opportunity to maximize that. Because for those of you that may not know this, the tax law that went into effect January 1 of 2018, which actually increased the deduction on your standard deduction, it almost doubled it, and reduced your tax brackets, is going to go away December 31st, 2025. So that means that when you all wake up January 1 of 2026, we're going to be in a higher tax bracket automatically than we are today, because everything is going back to the old law. So therefore, you have a 6-year window. Remember what I said about the definition of insanity? Doing the same thing over and over again and expecting a different result? Well, you need to avoid that. You only have a 6-year window. So you better start doing some tax planning if you want to survive in the future. Your retirement life is going to look much different if you maintain a proper balance between your taxable bucket, your tax deferred bucket, and your tax-free bucket. If you don't have the right balance, chances are you're going to fail in your retirement life. And you're going to have to, once again, adopt different paradigms. that are going to be able to address the new retirement challenges in the 21st century. So those things are important. Now, I just mentioned the new tax law that just went into effect January 1 of 2020. And it's important to note, I'm not going to go into a lot of details, but I'm just going to give you the highlights. Age limit was eliminated for traditional IRA contributions. It used to be 70 and a half. What that means now is that under the old tax law, if you worked and you were 70 and a half and you wanted to make contributions to an IRA, the government said you couldn't do it. Well, now they have done away with that. So if you're 75 years old and you either have your own business or you work part-time or whatever you do and you want to put money into an IRA, you have the ability to do that because the government is realizing that people are living a lot longer. So therefore, they need more and more savings in order to make ends meet. Because at the end of the day, you don't want to run out of money before you run out of life, because then the rest of your life is going to be very challenging for each and every one of you. The RMDs, which are the required minimum distributions, that in 2019, if you had turned 70 and a half in 2019, you needed to start taking money out of your IRAs and 401ks and pensions, whether you needed the money or not. Well, now that has been extended an extra 2 years to the age of 72. So now once you get to age 72, actually a year and a half, but it's still giving you a little bit of a break. So now you can wait till age 72, as long as you did not turn 70 and a half in 2019. So if you turn 70 and a half in 2020, then you can wait till 72 and obviously every year thereafter. So that's a good thing as well. There's a new exception to the 10% penalty. Most of my clients don't, and this is not applicable. This is for, birth or adoption. So if you're younger, obviously that's a plus for you and your family. The safe harbor, this is a great benefit now for employers because, annuities are some of the only vehicles in the marketplace that will allow you to guaranteed income for life. Well, employers now have the ability to be able to bring annuity pension plans and offer those to their employees because there is protection, government protection for annuity plans as well. And then one of the major challenges, now this is a negative impact, is what is known as a stretch IRA. Just to give you a quick issue on that is that, let's say when one of your parents passes away and they have an IRA or 401k, now you are the beneficiary. That means that under the old law, you are now the beneficiary out of the IRS. You needed to take money, the IRA, you now needed to take money out of that IRA every single year. But you could use your mortality. So if you were 45 years of age or 40 years of age or 50, when your mom and dad passed away and they left you $500,000 or $100,000 in an IRA, now you could have taken a very small portion of that on an annual basis because the distribution would be based on your mortality. So if the mortality for a 50-year-old is 86.4 years of age, that means that you would be taking 136 in the first year and then 135th, 134th, and so forth. So you would allow the rest of the money to continue to grow tax deferred, which would be a benefit for you. Well, nowadays, under the new tax law that just took effect January 1, 2020, that has changed completely. So if the death happens after December 31st of 2019, that stretch IRA that you could have taken all the way to your mortality, now that money has to be taken within what is known the 10-year rule. You have to take that money out within 10 years. Now, you don't have to take the money out every single year. So the required minimum distribution under the old law, that if you were 50 years old and you were the beneficiary of an IRA and you needed to take that 136 or 135th, you don't have to do that anymore, but you better have that account totally emptied by the 10th year. So if you don't take it on the 10th year, you have that required minimum distribution on the 10th year, and you have to empty the account. Otherwise, you're going to have to pay all kinds of taxes and penalties, and none of us want to do that. So now there are some exempt eligible beneficiaries that can still use the old law as opposed to now the fast 10-year rule. And by the way, the reason for the 10-year rule is simple. The government wants their money a lot sooner. They want their taxes a lot sooner. So that's why we've gone from a mortality rule to a 10-year rule. So who are those exempt beneficiaries? Well, surviving spouses, minor children, disabled individuals, the chronically ill, and beneficiaries that are not more than 10 years younger than the IRA owner. So if I die and my wife is within, obviously she's my surviving spouse, she can use the old law. So those are things that are very critical for us to understand. There's more to this. Every single day I see new IRS publications kind of clarifying some of the points under the new law, and that's probably going to take 6 months for them to get through it, but this is the gist of it. So how do those required minimum distributions work? Whether they're applicable to you at the age of 70 and a half or 72 and a half? Well, easy. In this case, when you reach the age of 72, then obviously you're going to divide your prior year's ending account balance by your remaining life expectancy. Obviously, you are the IRA owner or the 401k owner or the 403b. So let's say you have a balance of $500,000 as of the previous year. You're going to take that $500,000 and you're going to use the uniform lifetime formula, which is a formula that I'll share with you, that the IRS forces you to use. So you take $500,000, you divide it into the formula. In this case, it's 25.6, and that gives you a minimum distribution of $19,531. Now, you can pull more money if you want, but that would be the minimum that you must take out. And this is, as I just talked, this is a uniform life table. Notice that at age 72 is 25.6, at 73 is 24.7. So every year you take whatever you had total balance in your qualified accounts as of the previous year, and you divide it by that formula. Most financial institutions will do this for you, but it is your responsibility that you're taking the right amount of money, because otherwise, if you don't take it, there's a 50% excise tax penalty plus taxes that you would have to pay on the money that you should have taken, but you didn't because either you forgot or you made a mistake. So one of the things that you're noticing, as I covered in the uniform lifetime table, is that the longer you live, the higher the distribution rate. You know, at age 72, it's about almost 4% distribution. By age 100 is 16%, as you can see there, okay? And that creates a law, what I call the law of unintended consequences, because the higher the distribution in a high tax environment, the higher the tax liability. So one example that I can give you, let's say that you retire today at 72, if you're married filing jointly, your standard deduction is now $27,000 in 2020, which would be $24,400 for the standard deduction, plus $1,300 each for you and your spouse, for a total of $2,600 for additional deductions. So the RMDs at 72 are 4% of IRA balance as of 12/31 of the previous year. So if your IRA balance was $500,000, that's the one that we discussed, your RMD would be $19,531. Therefore, since your RMD is $19,531 and is less than the standard deduction, an additional deduction of $27,000 on top, then you would actually not pay any federal income taxes on that IRA. And you're going to say, Bert, but didn't you tell me that in the tax deferred bucket, the money that you put in is pre-tax and money grows tax deferred, but then when you pull it out, you got to pay taxes on the whole thing? Yeah, I did say that, and that's a law. But if you do proper tax planning and you can get to a point in your life where you can start taking money out of your IRAs and that distribution stays below your standard deduction, guess what? Now you have the best of all worlds. Now you're able to take that money, put the money pre-tax, have it grow tax deferred, and then pull it out tax-free. You can't get any better than that. But if your IRAs grow too much, and that's why there's an optimum level there, then obviously you may not be able to do this. So if you only took your RMD at 72, then if you only took the 19,531, then you pretty much wasted away for that year an additional distribution, tax-free distribution out of your IRAs or 401ks of $7,469. Now you may say, well, Bert, I don't need that money. So why do I need to take it? Well, take it anyways. Put the money into a Roth. So now you're converting something that you've never paid a single dollar of tax on onto an account that is going to grow tax-free for the rest of your life. So you would be a fool not to take the additional distribution as long as there's no tax liability. Why wouldn't you do it? You should do it every single day of the week. So 27,000 minus 19,531, that's 7,469. That can go into a Roth IRA. That can go into a lot of other different things that may be suitable for you and your family. So the reason why I've been kind of sharing all this with you is that, you know, most of us look at our finances through a microscope. None of us look at it through a telescope. Now you may wonder, Bert, why do you have in this retirement distribution and tax planning presentation the FedEx logo? Well, number one, is one of the most famous logos in the world, but there's a subliminal message in the logo. So if you take a look at the logo, if I were to ask you, do you see the arrow in the logo? Actually, 95% of you, according to statistics, do not see the arrow inside the FedEx logo. But once you see it, once you identify it, even if you're driving down the street and you see a FedEx truck, you're definitely going to be able to always, for the remainder of your life, be able to see the arrow where 95% of the people don't. Where is the arrow located, you may ask, in the FedEx logo? Well, just take a look at the empty space between the E and the X, and it creates a subliminal arrow, which basically means that FedEx is always moving to the right and always moving in the right direction. So again, when you look at making financial decisions, make certain that you do those decisions and you view them through a telescope as opposed to a microscope. Quickly on Social Security, this is one of the biggest issues. Most Americans don't think that they pay taxes on Social Security. Well, you're going to learn something totally different. So the way that there's something called provisional income calculation, the vast majority of advisors out there in the marketplace have no idea what I'm about to share with you. You may actually know more at the end of this webinar than they do about this. But the question is, are your Social Security benefits taxable in retirement? Because obviously the money that you put into Social Security was a tax, so you would think that you should get it tax-free. Well, the answer is it depends. And the way the calculation is done, which is something I do for all my clients on an annual basis, is for the year of the calculation, I take 50% of the Social Security benefit that the client receives. To that, we have to add ordinary income. That would be your if you work part-time or if you have any business income, any money that you're taking out of your IRAs, your 401ks are going to be taxed as ordinary income. So you have to put it into the calculation. You're also going to add your dividends and your capital gains. So you have to, any dividends and capital gains that you receive, you're going to have to add them. Any 1099s, anything along those lines, you will add. And then any interest that you receive out of non-taxable interest, pretty much municipal bonds. So although the income that you receive out of a municipal bond fund or a municipal bond is federal income tax-free, that distribution has to be added to the provisional calculation in order to determine what percentage of your Social Security benefits are going to be taxed in retirement. And there's a formula, there's a threshold. So if you're single, and once we do all those calculations, if the total income is less than 25,000, then, bless you, you pay no taxes on your Social Security income. If it is between 25,000 and 34,000, then up to 50% of your Social Security benefits are going to be dragged into the tax table, and you're going to have to pay taxes on that. And if the income exceeds 34,000, then up to 85 cents out of every Social Security dollar you receive will be dragged into the tax equation. And that's a bad thing. Well, what if you're married filing jointly? Well, if the total income is less than $32,000, excellent, no taxes whatsoever. If it is between 32 and 44,000, then 50% has to be dragged into the tax equation. And if your income exceeds 44,000, once again, up to 85 or 85% of your income will come into the tax calculation. So the idea is to create as much tax-free income as you possibly can in order to avoid the taxation of your Social Security benefits. Because what happens is, if you have to pay taxes on your Social Security benefits, then now you have less money to live on, so you're going to have to dip more into your retirement accounts in order to take more money in order to offset or plug that hole. But then again, by taking more money out of your taxable and tax defer accounts, now you're creating a bigger hole. So it's like, you're damned if you do and damned if you don't. So that's something that we all need to pay attention to. So in summary, the current and the future tax landscapes are going to have a critical impact on your retirement success. So that means that not only do you have to live for today and understand what the tax laws are today, but you have to start thinking about the worst that can happen to you in that tax Armageddon, or that tax train that is coming down the track. And you need to start shifting your assets in a way that you're going to be able to maximize your income and minimize your tax liabilities. Now, it's also important to understand income sources and their application for your retirement success as well. And financial decisions must be viewed, as I have already talked about, through not only a microscope, but most important, a telescope. Because a financial decision that you make on one side of the ledger may have a positive or a negative impact on the other side, but unless you look at your assets through a telescope, you're never going to know. So that's important to understand. Hopefully there are no questions. I can now at this point in time, because this is a webinar. Usually we take a break during the traditional seminar that I do, and then we answer questions and so forth. But quickly, let me get into the stock market and one of the challenges that I see now with many of the clients that I engage for the first time. And this is going back to 1929. By the way, the last time that we had a bear market was in 2009. So we are actually now going into the 11th year of a bull market. But we're a lot closer to a bear than we are to a bull. So what are some of the things that I can tell you about? And I'm looking at the S&P 500, but it's applicable all throughout anyways. A bear market occurs approximately every 5 years. The average decline is 39%. It actually lasts about a year and a half, and it takes about 5.2 years in order for you to recover. One of the major challenges with that is that when you're in retirement, you cannot afford a bear market. So if you have all of your assets exposed, one of the things that I jokingly say all the time is that only when the tide goes down will you know who is swimming naked. So, unless there's a stock market crash, now is when we'll know who is swimming naked in your retirement planning and your retirement protection. Food for thought, obviously I just discussed that, so that's important. And you have to figure out what are some of the things that you need to do in order to protect your retirement assets. Because if your assets are going down in value, and at the same token you have to pull money out, then now you are in a no-win situation, because you have to deplete assets that are losing value every single year, but you need to maintain your standard of living. So the old paradigm is that the stock market is always going to vindicate itself. Buy and hold may be an appropriate long-term investment philosophy. Again, that's the old paradigm. Asset allocation is going to protect your retirement distribution or assets during volatile markets. But that's not the case. The new paradigm is actually totally different than the old paradigm. The stock market is unpredictable and very volatile. Buy and hold may not be the right thing to do. It actually may be incompatible with volatile market when it comes to your retirement distribution planning. Diversification through asset allocation is not going to be enough. It may help you a little bit, but it's not going to be enough when you have to take money out of the assets. In 2008, the entire market dropped. That was a systematic risk. And in the seminar that we do, we go more into details. A down market at the wrong time may actually force you to either continue to work longer, postpone your retirement indefinitely, who knows? So it's important to understand that, you know, back in 2008, many investors lost anywhere between 30 and 50%. Now, if you were still working and you were not in retirement, well, you had a paper loss. But what if it happens now and you are in retirement and you got to go into those accounts and take money out? Then what? All of a sudden, your accounts are dropping in value between 30 and 50%. And on top of that, you got to take money and pay taxes on that distribution. What, are you kidding me? There's no way you're going to be able to make it. You're definitely going to run out of money before you run out of life. So another question is, well, how long does it take for the average American to recover? Let's say that you have a 40% portfolio loss on a given year. Well, if you want to get back to where you were, you have to get 67% return in 1 year to get back that 40% that you lost. But I have never seen a 67% return in the stock market. So it's going to take you a number of years for you to be able to recover. So even if you say, you know what, Bert, the market crashed, but now the market is growing again, and you know, I think I can do 8% every single year. Well, if that's the case, it's going to take you 6.6 years at an 8% growth every year. And that's, by the way, without you taking money out of your account. Because if you're in retirement, you're never, ever, ever going to recover. So that's something. Protecting your retirement assets is as important, not only from a volatility standpoint and stock market standpoint, as it is from a taxable and inflation perspective. Look at the S&P 500 the last 20 years. Those peaks were very high. The valleys are pretty low. Take a look at, for instance, let's look very closely at 2003, when the market crashed for the first time. It took until 2008 for the market to recover. So if you were in retirement in 2003, you had a 5-year window in order to recover, but you were taking money out of your accounts because you had no choice. And then when it happened again, the peak there in 2008, and it went down by 57% in 1 year. It took what, all the way through 2015, almost 2014. So it took 5 years once again for anyone to break even. And that's, again, without taking money out of the account and allowing that account to continue to grow uninterruptedly. So that's important. Again, it's obviously, you know, what's going to cause a crash. A lot of things can cause a crash. Interest rate jumps, cyber attacks, with the finger on the trigger. You know, who knows what may happen in the future. Emerging markets in distress or chaos. Trade wars. Actually, we're living through some of those right now. Political impeachments. We're definitely living through one of those. Tax laws and government regulations. Tight labor market in the US. We're actually getting to a tight labor market today. Inflation, deflation fears. So there's a lot of stuff that can hurt the economy and hurt the stock market, and by the same token, hurt your account. So it's important to understand the difference between accumulation of assets and distribution of assets and income. They're totally two different things. Most people don't think through those. A well-structured distribution analysis can identify future retirement hurdles that you need to prepare for and how to do it the right way. And then the protection of capital assets are a must in retirement. So at the end of the day, we're not going to get into a lot of details on any specific products, other than there's a product out in the marketplace. It's called a fixed index annuity that gives each and every one of you the ability to take a portion of your assets, put it into an account where you can participate in the growth of the stock market during good times, but you don't participate in the decline of the market during bad times, during bear times, because of the fact that your principal is always protected. So that's the best of all worlds. Now, what percentage of your assets should you have in a principal protection program? It depends. It depends on how old you are, how much money do you have, what are your retirement needs, what are your expenses needs, what is your standard of living. So a lot of those things are taken into account, but considering a fixed index annuity, and there are many companies that offer them, and it's just like ice cream, like Baskin Robbins, there are 31 different flavors. You need to talk to someone that understands that market very well in order to help you protect yourself and your family from a tax and a stock market decline in the very, very near future. Now, why is it important to make certain that you can protect your assets? Well, we have a tendency to protect everything else, right? We protect our lives, our cars, our homes, our ability to earn an income every year. We protect ourselves from the risk of living with a disability, like long-term care. So portfolio protection, why would you not think about protecting your assets? Why would you not think about protecting those assets that are so important to you and to your family? I just want to leave you on this risk mitigation at this point in time with this, because, you know, normally in our seminar, we go into a lot more detail. So at the end of the day, what you want from a retirement standpoint is to make certain that you always have a safe landing. You obviously don't want to jump out of an airplane without a parachute. And the stronger the parachute that you have, the better it's going to be for you, yourself, your family, and your business for many, many years to come. So in summary, you know, again, accumulation versus distribution. Everyone thinks about accumulation. No one thinks about distribution. Distribution rates versus the accumulation rate are two different things. By the way, most advisors in the marketplace do not understand retirement distribution because they're so fixated on retirement accumulation that they don't pay attention to the pros and cons of retirement distribution and how to segment your assets in a way that is going to provide maximum protection and maximum benefit to you and your family. Sequencing of returns are critical in retirement. We just covered that. Principal protection and asset hedging may determine success or failure in retirement. That's critically important. So now we're getting toward the end of this webinar. We're just running a few minutes over, but I'll have you out of here in the next few minutes. And what I'm going to share with you is something extremely important that most of you are going to help you legally divorce the IRS in retirement. Yes, you can do that. Now remember, there's a big difference between tax avoidance and tax evasion. We do tax avoidance every single day with our clients. We will never, ever, ever try to do tax evasion, okay? So let me give you an analogy that I use when I go into the detailing of what I'm about to share with you. So when you take a look at an airplane, when they take off and when the airplane is in the air, there are certain forces of flight, and this is an analogy that I use, you know, with all my clients. So for instance, when you look at it from a financial standpoint, compound interest provides lift to your financial airplane. Tax favored investments like IRAs, 401ks, 403bs, Roth IRAs, Roth 401ks, they provide thrust, the ability to get from point A to point B at a faster rate. Financial fees and losses, on the other hand, they're going to create drags. So we need to reduce as many of those as we possibly can. And then taxes and inflation are going to add weight to the airplane and is going to add a lot of weight to your financial and your retirement airplane as well. So I'm going to share a quick exercise with you. And this is an exercise, this is actually an actual exercise, actual numbers. I'm not sharing with you any information as to the name of the clients or anything like that, but that's important to note. But the reason for this exercise is for you to understand very critically that when it comes to retirement distribution planning, not all income is created equal. And I'm going to explain to you why. In this case, if you see there, let's say you're taking $50,000 out of an IRA or your pension, and that's the income that you're going to report for tax purposes in 2020. Well, your tax liability has you there on the top, which says 50,000 and 12%. That means that you are in the 12% marginal tax bracket, but your effective tax rate on the bottom line is only 4.74% because your tax liability, if you move to the left of that, is $2,372. So you may say to me, you know, Bert, if I'm taking $50,000 out of my IRAs and I'm only paying $2,372 in taxes for an effective tax rate of 4.74%, and we don't have the time to give you the difference between the marginal and the effective, just follow me along those lines, then I would do that every day because the tax is not that bad. So the question is, well, what if we can improve on that situation? What if instead of taking $50,000 out of your IRA, what if you start taking Social Security benefits and now you're taking $35,000 off Social Security benefits? You still need $50,000. So now if you look on the left-hand side, now you're gonna compensate that by taking $15,000 out of your IRAs for a total of $50,000. Let's see what the tax landscape looks like now. As you can see, your tax liability is zero because now you're taking $50,000, but you're paying zero in taxes. So in reality, you have an additional income coming to you of $2,372, almost $200 a month. That can be spent, that can be saved, you know, that can be a small vacation, that can pay some utilities. So what I'm trying to help you figure out here is how to maneuver through all your tax buckets in order to minimize your tax liability. You're still living on $50,000 of income, but now that $50,000 is giving you a tax liability of zero as opposed to $2,372. So now the question is, well, if I'm pulling $15,000 out of my IRA and I'm getting $35,000 out of my Social Security benefits, how much more money can I take out of my IRA or 401k and not have to pay a single dollar of income tax? Because I would want to know that. If you have an IRA or 401k, you better know how much you're going to be able to take out, if anything, without having a tax liability. And in this case, I can actually take $22,000, so I can take an extra $7,000. So now my total income, as you see there on the right, toward the bottom, is no longer $50,000, is now $57,000, an extra $7,000, and my tax liability is still zero. Remember, in the very beginning, the tax liability of $50,000 was $2,372 for a 4.74% effective tax rate. Now your tax liability with more money in your pocket is totally tax-free, from $50,000 to $57,000. Now, the next question is, well, I would ask us, well, listen, if you were so happy of not having to worry about paying that $2,372 under the first scenario on $50,000 of distribution, how much more money can you pull out of your IRAs that the most you're going to pay in taxes would be the $2,372? So again, my system does all these calculations for you. So we take a look at the $35,000 of Social Security benefit, and now we added another $35,958. So now your income has gone, if you look at it, your income has gone from $50,000 to $70,958. So you have an additional $20,958, and you're having the same tax liability as you did when you were only using $50,000 of income. Is that crazy or what? So isn't this something that you need to know? Remember, distribution, the efficiency of distribution planning is going to help you maximize the benefits for you and your family at the least amount of cost possible. Now, if you don't do any tax planning, you're never going to know this. You're never going to know those calculations. Now, another question is, well, what if you have long-term capital gains? What if you sold a piece of property? What if you sold some stocks that you had nice gains on? Well, $50,000 of long-term capital gains, as you can see there, notice that the tax liability is still zero. Why? Because $50,000 of capital gains distributions are not $50,000 of ordinary income tax IRA distributions where you paid that $2,372. Here, that same $50,000 is tax-free. What if you have $105,000 of long-term capital gains? Now you're going to say, well, Bert, if you're going to take $105,000 out of long-term capital gains, there are definitely going to be taxes today, correct? Well, not really. Your tax liability is still zero. And the reason for that is that I can take a lot of money, that's $78,850 under or north of $78,000 of capital gains. And then when I add my standard deduction and credits, then it brings me up to $105,000. Therefore, I can take out up to $105,000 out of capital gains and not pay a single dollar of income tax. Isn't that crazy? What if you have $75,000 long-term capital gains and $25,000, as you see there on the left, of IRA distributions? So now you have a total of $100,000 of income. Guess what? Your tax liability is still zero. But how would you know if you don't do a proper tax plan or you don't do an audit of your existing retirement accounts? So in conclusion, your personal tax map is going to vary greatly based on your personal circumstances. I think it's important for you to kind of schedule a complimentary consultation with me, and I'll do a tax plan for you at no cost or obligation. And I'll also throw in there a Social Security report just as well. A tax-preferred retirement life is paramount for retirement success. So it is very, very important that you can minimize your taxes and maximize your income benefits in retirement. So for those of you that may want to engage in a complimentary consultation with me, just go ahead and reach out to me and we'll schedule a 30-minute strategy session. And you can get your free tax planning and Social Security report. And by the way, no obligation as well. And then determine the viability of a tactical retirement blueprint. So once we do those 30-minute conference call, and you can ask me any questions you have, I'll give you that tax planning report and Social Security report designed specifically for you. And then we'll figure out if doing a tactical retirement blueprint may be suitable for you. Obviously, as you see there, Bert Salazar. You can reach me at area code 786-766-1042. Again, 786-766-1042. Or you can send me an email at Bert, B-E-R-T, at gablestaxgroup.com. Feel free to go ahead and send me an email. Take a picture of this if you have your phone with you. And this is the end of the educational course at this point in time. So what I'd like to do is I want to share my video for about a few seconds and then close this webinar. And again, for those of you that joined us this morning, we went a little bit over time, but as you can see, the amount of information is tremendous. So always remember that my number one goal is to help you and your family, as I said at the very beginning, kind of change the way that you see things. And I think we've done that today. Because when you change the way that you see things, the things that you see change. So again, thanks very much. I'll keep you posted on the next seminar, and I'll keep you posted on that. So if you want to attend, obviously you're going to be privy to a lot more information as well. But for now, have a wonderful day. Talk to you soon. Take care.